So welcome back to another video, guys. Wishing you all a very happy new year. So just a couple of updates. Number one, if you have doubts, please make sure your comments come in on Saturday itself. That is the day video is releasing. Sunday I'll be taking a complete break. And number two, the next update on the market, the video will be coming out on 20th January. So next week there won't be any update unless and until, of course, I see that an update is required and something happens in the market and you need to pay attention to that. So I hope you have seen the market outlook video on 2024 that I did last week, that is just before New Year, because this is going to be a continuation of it. So I give you one slide about stocks in the healthcare sector, metal sector, MNC, service. Today I'll share one more with the kind of sectors I'm interested in banks, which stocks I'm looking at, FMCG, whether it is finance, whether consumer durables, the digital space, and those kind of things. So in the last week's update, I had specifically discussed that you need to understand cycles. You need to understand what a crash is in the market. How do you determine a crash? How trends are usually developed in the market, and how tracking short-term cycles and linking it with the medium term is always going to be beneficial. In this particular video, I'll continue with the same theme, but this time around I'll introduce you to a stock matrix and how do you categorize stocks, how do you go about it in 2024, and some general guidelines also I'll give you. So this is the returns versus risk matrix here, or a quadrant that you can call it. This is not exhaustive in nature. You can have any kind of numbering here. It is not that all stocks necessarily have to fall in all these quadrants, okay? Some can easily be outside of these quadrants, some might not qualify, and those kind of things. So there are four quadrants. Number one, undervalued underperformers, overvalued underperformers, undervalued outperformers, and overvalued outperformers. I'll just take 2 minutes to explain this. By undervalued, I mean, and I'm seeing this just through basic P ratio on the chart. So for that matrix, I'm using whether a stock is undervalued or overvalued. That means what is the industry PE and what is the stock PE. So that is how I'm using it, and I'm also using comparative kind of data. Let's say I'm looking into banking sector. I want to look at HDFC Bank's P ratio with respect to banking sector P ratio, and then how the P ratio of HDFC Bank starts, compares with other banks. I hope this point is clear. What does underperform means? Stocks that are not even able to beat Nifty 50 returns or marginally are beating Nifty 50 returns. So what does overvalued means? Stocks with P ratio greater than industry and greater than their peers. What does outperform means? It means stocks that have beaten index returns. I hope this particular quadrant is clear. So for 2024, this is how I have categorized all the sectors. So this is the returns ratio here, not ratio, but returns on the y-axis. On the x-axis, it is the risk. So as you move down, risk increases. As you move up, returns increase. Okay. So look at how I have categorized this particular year. This is just for me. This is not exhaustive, and I can completely be wrong. So the undervalued sectors which have underperformed, in my view, are banks, finance, metals, IT, and private banks. This is a space where returns is higher and risk is relatively lower. Okay. So this particular quadrant that you see, overvalued underperformers, in this I've placed mid-cap IT, mid-cap metals, mid-cap banks, NBFC, and those kind of names. Because valuation wise, these have extended a bit. Although in terms of something like realty, capital goods, PSUs, FMCG, they have underperformed. That is why they're in the underperforming kind of segment. But just because they are slightly overvalued, I have placed them here, which signifies the potential return that one can get when the cycle is right. Also, the risk is high because of these fails, because the fact that these are underperformers and overvalued, correction will be more here. And it's not that those stocks and sectors that have outperformed, something like infrastructure, consumption, pharma, healthcare, or realty, capital goods, PSU, FMCG, auto, are not going to give any returns. But in case the market cycle has to reverse, do not forget we have entered this year with a lot of optimism. We've entered this year thinking that everything that was wrong in 2023 with respect to interest rates, with respect to political uncertainty or whatever, has all been sorted out, and we are going to have a really amazing kind of a year. That is the bullish commentary you're seeing everywhere. So if that is not going to be true, then these are the spaces where people have made massive amounts of money. So upside in these spaces, at least in the near term, near 6 to 8 months, is limited. It's not that Nifty will go up and these spaces won't go up. They will. But if Nifty or other broader market indices, or there is a correction coming in the market, then this is where risk is high and return is capped. So that is how I've categorized this space. So I hope this particular matrix is clear. There is quadrant and the sector kind of outlook, how I've defined, this is also clear. Now I'll move to some Nifty 50 stocks or some stocks that are good pedigree companies, so that I can take the name of these companies. How I'm categorizing it, so that you can do it for yourself, for small cap, for mid cap, for any other sector or index you track. So in the undervalued underperformers, I will put in something like SBI, Wipro, Tata Steel, JSW Steel. Now these stocks valuation wise are just about at their mean. They have not performed that much. Yes, you're seeing movement in Tata Steel, JSW Steel, but not at par with many of the winners in the market. In the overvalued underperformers, by overvalued here, I've put in HDFC, Infi, TCS, Unilever. Their P ratios are above industry P ratios, above their peers. That is why I've mentioned overvalued here. But they are seriously underperforming. HDFC Bank is doing nothing. Infi is doing nothing. I'll put in ICICI Bank also here. TCS has done nothing. Unilever has done nothing. If the market cycle has to continue, if Nifty 500 and all these indices have to go up and rally another 15-20% in this year, then I think this is the space. This space, undervalued underperformers and overvalued underperformers, which will exhibit more momentum and more return than something like undervalued outperformers and overvalued outperformers. That is just my take. So now when it comes to undervalued outperformers, the reason why I put in ITC, LT, Cipla, Britannia and those kind of names here is because they are very close to industry Ps. All right, something like Britannia is certainly not as richly valued as something like Nestle. So I hope you get my point. They're close to their mean valuations, especially 1 year, one year forward guidance if you want to take that particular point. And they are outperforming. ITC has done very well, L&T has done very well, Cipla has done very well, and so has Britannia. I'll be very wary of stocks that fall in this segment. Remember, I've just taken these names as an example. So stocks that have run up too much in the last 6 months, something like Nestle, DLF, HAL, Tata Motors, all these names have run up too much in the last 6 odd months. They need a lot of time consolidation. So that is why if the rally has to continue, this is the segment, or your stocks have to fall in this segment for you to have a decent amount of chance to make good returns in the market. Now I'll just pick out 2 names to show you what kind of comparative analysis I do, how I shortlist names. Once I've shortlisted names, then what do I do about those names? So for example, I've selected one from undervalued underperformer, which is SBI, and one from overvalued underperformer, which is HDFC Bank. Before I go to the charts of these 2 stocks, this is a slide I shared to you in the last week of December also. That's stage 2. No matter which stock you select, it has to be in a stage 2 structure. If you select a stock and it is in this structure, that is, it is consistently making lower high, lower low, just skip it. Don't waste your time, don't waste your money. So first is the chart of HDFC Bank. Let's say I want to invest or start my SIP, STP in HDFC, SBI. How do I shortlist these? The first thing I would like to see is the weekly time frame structure. Now, what do I see on weekly time frame on HDFC Bank? First, this is 2021, roughly January first quarter. Currently, we are in the first quarter of 2024. 3 years, stock has gone nowhere. I like this. I like this because this has been an underperforming stock. Around this region itself, you're seeing a lot of up and down movement happening. I'm seeing a lot of resistance. This resistance starts from October 2021, and it's going on even now, that is October 2023. So this resistance between 1620 and 1760 is what HDFC Bank is not able to cross. Now, why such structures are a bit dangerous? Because you don't know if the industry cycle or the market cycle turns. These are the stocks which will quickly again move back to 1480. So I always prefer charts like SBI. Now look here. Now SBI has definitely given more return than HDFC Bank, but it was at 500. I don't have the chart here. 500 something in last quarter of 2021. It's just at 643. So it's given roughly about 18% return in the last 2 or 2.5 years maybe, which is nothing. Nothing in terms of what SBI is as a company. That is India's largest bank. The balance sheet is relatively clean now. NPA is relatively less. It's well within the margins defined by Reserve Bank of India. The deposit growth rate is really good. Net interest margins are, I think, second to HDFC Bank, that is in terms of size. Now, what has this chart done? It's gone through 3 contractions and it's had a breakout in the last quarter of 23. From there, if you look in the last 3-4 weeks, the stock has gone nowhere. So compare this chart with this chart, a chart where there is a lot of resistance and a chart that has broken out and is consolidating right at the breakout level. So if my reading is correct, this is absorption of supply going on. All right. Everything in the end is linked to the cycle. So I'll come to that particular point later. But for the time being, just understand when you are trying to pick out stocks in this particular quadrant, any stock that falls in these quadrants, then you have to do a comparative analysis because everybody's capital and money is limited. Only the best of the best stocks deserve to get your money. I hope this part is clear. Then there are some valuation matrix. These days there are a lot of softwares out there that can plot this for you that I'm showing you on the screen. A lot of Indian apps are also there. You can use it. I just use it for a rough estimate. Please do not use this data to determine what is undervalued, overvalued, those kind of things. Okay, so this is just a rough guideline I like to see. So this data that you see is for HDFC. Now in HDFC Bank, the company has a P ratio of 23.6. Industry P ratio is 12.4. The market P ratio is 30.4. So while HDFC Bank is, relatively better valued than the overall market, it still trades at 100% premium when you take the industry. When you look at SBI, now this is SBI data. Its P ratio is 8.4, whereas market is 30.4, industry is 12.4. So it is relatively undervalued from the industry and really undervalued when it comes to the market P. All right. Now this is price to book ratio. HDFC Bank trades at 3.1 times price to book ratio. The market trades at 2.4 times. The industry trades at 1.6 times. If you look at SBI, it trades at 1.5 times price to book ratio. Industry is at 1.6 times and the market is at 2.4 times. There is one thing I'll tell you, that when it comes to assessing valuations, you will hear a lot of fancy terms from a lot of people. Are they wrong? No. Are they better educated? Yes. But is a lot of complication required in trading and investing? No. It's not required. Basic things work very well. I connect with you only once a week. So there are a lot of things, the simple things that work on real-time basis. I cannot show it to you. But I do have a very small community here. And what we do 24/7 is track really basic data points in the market. And those work very well. And majority of our small community here have done exceedingly well using very basic tools. Okay. So I'm a big believer of that. Now here, if you see, this data is again this particular software giving out its own version of valuation. I take it for reference only. So the fair value of HDFC Bank, it states it's 652. Currently the price is at 1690 or 1700. It's 160% overvalued. For SBI, it tells me that fair value is 466. The current price is 642. It's about 38% overvalued. All right. Again, this has to be used as a rough estimate only. So what I have done here is use basic charts. So if you look at the previous slide, it was just basic demand and supply analysis, and then I like to see in terms of valuation. And of course, I've done the basic work of going through HDFC Bank's numbers. For instance, if you look at HDFC Bank, its 3-year ROE I think is between 7-8%. Its ROC, that's it. ROE I think 3 years is between 16 to 17%. It's seeing a healthy net interest margin growth. Overall numbers seem to be fine for something like HDFC Bank. For SBI also, it's a stock that is trading at 8.4 times price to earnings ratio with the return on equity of close to 17%. Again, it's an excellent combination. It is a combination that fits perfectly here, which is an undervalued name. It's an underperformer. Due to a lot of market related news flow, this was a stock that took a hit. And since then, it has just struggled a bit. It's recently broken out, which is a great sign. And I think for 24, such charts should definitely be on your radar. Once you're through with charts, once you're through with basic fundamentals, and those kind of things, and everybody should know basic fundamentals. It's not that difficult at all. There are plenty of people, genuine people on internet who teach you things for free. Just because you're paying for some expensive webinar or seminar or whatever does not mean those teachers are unbelievably good. A lot of people teach market analysis for free. If you open your eyes, give them credit, you will find such people. But again, free is considered useless in the real world. That is just how things work. So this is an accumulation cycle. So let's say I select one particular stock. My analysis is done. Now in 24, how would I define how I need to build positions? Always remember, at a beginning of a cycle, one time scale in you can always do. But identifying that beginning of a cycle always becomes tricky. At the middle point of the cycle, if you ask me, from a 10-year point of view, we are right in the middle of a really healthy bull market. In between, you'll get a quick nip of 20% somewhere, I don't know when, but we are in the middle part of a bull market. All right, but let's come to 24 specifically. For 24, I think we are somewhere here. Okay, now there are two things that can happen. If you allocate a lot of money here, it's possible few months down the line you see something like this, your portfolios will be in red. So since I'm assuming we are here, the safest way in this particular cycle is to go through the SIP STP route. SIP is gradually allocating money every month. STP is something that I teach where I encourage people to allocate money on every Friday on stocks they like. Okay. Now, why this is important? At times what happens is, see, it's very clear at this point to see that this has happened. But when you're somewhere here, there are two things that can happen. Market can consolidate here and stage a fresh breakout and move up, or market can consolidate here and stage 4 can begin. So I'll quickly take you through the stage chart. At this point, it's very easy to say that this was a stage 4 cycle. But at this point, there are multiple routes market can take. And that is just one route I'm showing you, that sometimes price does not fall like this. It just consolidates in a range and then heads higher. So for such a scenario, this method of slowly buying into positions is the best method. Why? Because as the stock consolidates up and down, you keep averaging out your position within a bullish cycle. And then when a final breakout comes on the upside, that is when your positions begin to show a lot of returns. Now, if you opt for a one-time scale in here, then what will happen? Because volatility is usually high here, you will get shaken out of your position. And then it will be frustrating to see the market will break out and move up. It can certainly break down, but I'm just giving you an alternate scenario. That is why when you are beginning a portfolio construction or trying to bring in fresh money near peak of a short-term cycle, so I feel we are somewhere here for the short-term cycle. There might be some more upside left, but after that, we will have to go through some period of strong consolidation. this is the best method for the names you select. Slow, gradual accumulation. Because do not forget that a market cycle is the single biggest factor for your account growth. See, there is a saying that bull markets make even the ordinary trader appear as king of stock market, but it is a bear market that differentiates amateurs from pros, and that is absolutely true. As of now, if you look at social media, if you look at the videos coming out, it's all about I said so, okay? And this is a classic telltale sign that it is bull market that is making people believe their ability to see market cycles, market trends, and those kind of things. The bull market is very forgiving because wherever you buy, few weeks down the line, price will be higher from that level. And that is when you begin to assume and feel that, you are really good at stock market. Some people try to feel they're the god of stock market and those kind of things. But ultimately, the truth is that the market cycle is the single biggest factor for account growth. Now, there are two things that are being said. Number one, growth story and fund flow. If you look at the common commentary, it is that India has an amazing growth story, and FII's fund flow is going to be coming into our markets like never seen before. If it's true, fantastic, we all will benefit. But always prepare for the worst. Hope for the best, but prepare for the worst. Now, growth story of India is intact, but growth is not related to returns of stock market in the short term. It always reflects in the medium term. Which is why a slow gradual accumulation, if the markets were to reverse also, will not cause much damage to your portfolio, to your account size, to your psyche. You'll still be in that positive frame of mind, and you'll be able to allocate money whenever the cycle turns next. Also, do not forget that 2024 is an year of events. Now, it is certainly possible that we have a markup phase here, like I've written. What is a markup phase? Where price moves up and your account will certainly see a lot of growth. But 2024, if you see, has so many general elections all over the world, as I covered in the first part of this video. We are also coming from a low volatility kind of a cycle. Do not forget this is important. Entire year last year, the volatility range was between 10 to 12 or 13. This will expand. It will happen in 24. There are a lot of bullish commentary that analysts are giving that central banks are going to cut rates. I've already covered that with respect to that, I'm not at all bullish. I don't think rate cuts are coming so soon in the global market environment, and volatility will continue, which is why you need to be aware of two things. Number one, how you scale in positions, and number two, how you plan which particular stocks and sectors you need to go behind. So while my plan dictates that I need to be somewhere in this particular space, it is entirely possible that you opt for a momentum phase and you go behind overvalued outperformers, because this is where momentum is really, really strong in the market. This is a valid strategy as well. It is just that I've given a different perspective of what can do well in 2024. That is, if market cycle remains stable. So I hope this particular video was helpful in terms of understanding where you need to be. I'll again come out with an update, not next week, one after that. In case there is something in the short term I need to cover, or the market moves a lot, that is when I'll see you guys next week. So make sure your comments come in today so that I can reply to it. Else I'll look into it on next Saturday. So have a great weekend ahead. Take care and be safe.